Thank you. Again, just to reintroduce myself, my name is Jason Peel. I am the Managing Director and Head of Mpho Radicle, which is our carbon markets platform at Mpho Capital Markets. It is my pleasure to moderate what I think will be a very interesting discussion, and really is a question for this generation, which is the investment in energy security, and how do we do this to answer the energetic demands of today in the context of our sustainability goals. I don't think it's a surprise to anyone in the room that the global energy landscape is undergoing a shift. With the weight of climate imperatives, geopolitical tensions, and unprecedented energetic demands, it necessitates financial and industrial institutions to rethink how we secure reliable energy while continuing to advance our sustainability goals. I am joined in this discussion by an illustrious panel. I'll do a brief introduction before we jump into our discussion. First to my left is Mpho Kubelo, who is the Chief Risk Officer at the Development Bank of Southern Africa. Next is Jean-Jacques Barbéris. He is the Deputy CEO and Director of Institutional and Corporate Clients Division and ESG at Amundi Investment Solutions. Next is Laurent Germain. He's the CEO of Egis. And last is Arnould, the General Partner at Jolt Capital. Thank you each for joining us. As I jump into this, I think the backdrop of this discussion is a significant shift in industrial demand, particularly from sectors like AI, data centers, electric vehicles, and advanced manufacturing, and how it is reshaping investment strategies. The International Energy Agency projects, as of April 10th of this year, that electricity demand from data centers worldwide is set to more than double by 2030 to around 945 terawatt hours, primarily driven by growth in AI. Jean-Jacques, if I can start with you, I'd be interested in how the unprecedented demand for power has affected your investment strategy, and what trends are you focused on capitalizing on?
Thank you very much, and good morning to everyone. For those that are not familiar with Amundi, Amundi is the largest asset manager in the world that is not American, and we are focused mostly on, I would say, public investments. So I will take that, I would say, vision of the market. As you were saying at the moment, I think the three trends that we see and that are helping us to decide our investments, it's first clearly the additional demand for power, with, as you were mentioning, is unprecedented. To give an idea, a little color of that, on top of the figure you mentioned, basically the data centers will represent 3% of the total electricity consumption by 2030, and they increase by 15% in terms of demand on a yearly basis. So clearly led by AI in particular. So for sure, this is something we need to take into account as an investment thesis, taking into consideration that a large data AI center represents somehow the consumptions of 1,000 households. So that's the first trend. The second is, of course, what is the offer of energy that is in front of that? And here, of course, on our side, there is plenty of focus on the development of renewable energy. Last year, it's almost half of the power demand by data centers that has been met by renewables, which is for us, I would say, a clear indication that it's going to be a trend to follow on an investment basis. And for the record, in the US last year, 90% of the additional energy offering was based on renewables. And the final element that we take into account in trying to forge our investment decisions on that front is a very strong focus on emerging countries and developing countries, where we do believe that there is an investment thesis to invest way more in the energy capacity, because first, the demand is there, and as well, because to meet our climate goals, most of the mitigation impact we can deliver going forward will be in emerging economies.
Thank you very much, Jean-Jacques. I mean, there's a couple topics there that I think we'll touch on as we go through, just the topics of emerging markets and renewable fuels and the role that they'll play. So thank you for touching on those, and I'm interested to delve a little further. Before we get there, though, Eric, I'd be interested from Jolt Capital's perspective, how some of your investments in deep tech, like semiconductors and electrification technologies, support the scale of AI and EV growth globally.
Sure, thank you. And again, good morning, everyone. So, scaling AI and EVs is not just about infra, it's also, or chips. It's also about brains, about data, and about business model intelligence. At Jolt, we invest in deep tech companies across Europe and worldwide, but essentially out of Europe. We just opened an office in Canada, and our latest investment, and I come back to this, is critical in the topic we addressed today. But to your point, I think the answer is twofold as being an investor. It's about, point one, making wise investment decisions, but also point two, transforming company at the age of AI. And with this, in this respect, what we do at Jolt is again twofold. One, we are not only an investor, we are also an AI company ourselves. Very early, we decided to create a data science team internally, with which we boosted a system which is, so we have a CTO, we have 5 data scientists. So creating an internal system to scout new companies, but also to support our portfolio companies. And I think one of the answers to your point is, it's not natural for many companies in the energy space to transform themselves in a way that really has an impact. And the way we do it is that with the support of our portfolio company, not only do we try to make good investment, but we push the boundaries. Let me give you just one example. Or 2 examples. We invested in a Finnish company called Virta. This company is doing software for EV charging points. What are we doing? We are transforming this company, being essentially a software company and a very good one with many patent families, into what we call a virtual power plant. And this is transforming what is a nice software into network efficiencies. This is at the service of energy efficiency, and this is something that, again, is not natural when you are a software company with software engineers. A second example, and last, is for now, is a company which is initially a spin-off of Soitec, the European semiconductor company, which is called Dolphin. The company is now headquartered here. It's our latest investment. And this company is doing initially IP, intellectual property bricks for semiconductors. Something which can be, at first sight, far away from energy efficiency. But look, this company is managing the power consumption in semiconductors through their IP bricks. What does it mean? It means that when you have an NVIDIA chipset, which is highly energy consuming, we are, as a matter of fact, pushing the boundaries to make it more efficient. And not only do we do this because we think it's nice and fancy and cool, we do this because we commit as an impact investor. In the first sight, we are a tech investor, but we have an engineer approach at Jolt, and most of our partners are engineers. And so we transform everything into KPIs. So in this respect, we set a new KPI, which I think is unique worldwide, and for an investor in gross equity, which is €1 invested, 1 kilogram of CO2 avoided. This kind of commitment is the way you have a tangible impact.
That's fascinating. Thank you for that, Eric. Like it's amazing to me. Your investment in AI, your investment in the technologies to support AI, at the center of everything you're doing, but also with a sustainability element and driving the energy consumption lower through time through your investments is fascinating. Mpho, maybe I will turn to a emerging markets perspective, and I'm curious on your views on how emerging markets interact with new technologies like electrified vehicles? And is there an opportunity to design new infrastructure with electrification in mind rather than what we're doing in many parts of the world, which is trying to adapt existing technology that is designed for a carbon economy?
No, thanks, Jason, and good morning, everyone. I come from the Development Bank of Southern Africa, which is a government-owned infrastructure bank. We do a lot of investment across sub-Saharan Africa. And being an infrastructure bank, it means that we do a lot of investment in the energy space, including electricity. That forms a big part of what we're doing. And one of the things that we know is that Africa as a region, sub-Saharan Africa as a region, the level of penetration of electricity is quite low relative to where it is in the world. What this means is that we have an opportunity to start building infrastructure that is adaptable to where we want to go in terms of sustainable infrastructure and how we evolve from where we are and start dealing with the sort of carbon issues, greenhouse emissions issues that we have. So in answering your question, I think we have an opportunity in the region to invest in basically to leapfrog. So instead of going back and starting to build on how the rest of the world has built and all of that, it gives us an opportunity to leapfrog and start investing in technologies that can adapt to what we want to go. I mean, over the last couple of years in South Africa, we have seen a massive investment in renewable energy. So we went through a period where demand for energy was much higher than what we could supply. And what we have seen government do and other players in the market is to invest heavily in renewables. And it's a program that we want to drive heavily going forward. We are now starting a new program around expanding our grid. The intention is over the next couple of years is to invest in about 14,000 kilometers of transmission network. We also are talking about regional interconnectors in terms of being able to build a strong market around the continent. And all of this gives us an opportunity to invest in a grid that is adaptable, a grid that is flexible enough to be able to accommodate renewables. The other strategy that government has come up with in South Africa is that we are a big assembler of motor vehicles. So there's a lot of motor vehicle assembly that happens in South Africa. So one of the areas where we want to focus is around EV, both for our own market as well as for the export markets that we focus on. So the answer to your question really is that we are looking at the developing technologies. We are looking at playing a big role in the electrical vehicle space. We're looking at how we expand our grid, how we expand our network, and making sure that it is sustainable and that we accommodate the new technologies that are coming up. Thanks, Jess.
Thank you, Mpho. For those of you, before I turn to Laurent, for those of you that aren't familiar in the room with Egis, that they are a global architectural, construction engineering, operations, and mobility services firm. And Laurent, I'm interested in your perspective on how companies around the world are adapting their infrastructure or infrastructures in difficult to decarbonize industries like transportation and construction.
So at Egis, we took very strong commitments in terms of sustainability. I mean, we measured 4 years ago the percentage of the revenues of the company directly having a positive impact on decarbonization, restoration of biodiversity, and resilience. At that time, the company was doing 1 billion euros of revenues, and 40% of our revenues were positively contributing to sustainability. Thanks to the strategic choices that we made, and I will come to that later, now 50% of the revenues are contributing positively, but the revenue has gone from 1 billion to 3 billion. So it's 1.5 billion directly contributing because of strategic choices. What are these strategic choices? On the building side, focusing on methodologies, eco-designing the buildings so that the impact on the energy consumption decreases. And we have many examples where through engineering work, we've been able to decrease by 60% the energy consumption of a building. This is what we have done, for instance, in the largest high school in France. On transportation, of course, we work a lot on decarbonized mobility. We are the major civil engineering companies for the new 4 metro lines of the Greater Paris, which hopefully will lead to the diminishing, I would say, the number of polluting cars in the city. So these are, some examples where we are bringing added value, so that in the polluting sectors, building and infrastructure, we have an impact in terms of decarbonization. But coming back to the energy sector, and the reason we've been growing in terms of the contributive, positively turnover of the company, is that we are focusing a lot on the energy sector. And of course, you highlighted the increase of the energy demand, but there is a second big trend in the last 3 years, which is the energy sovereignty. And the combination of growing demand and energy sovereignty has led to many decisions or many conclusions. And the first one is stopping putting in competition the clean energy sources. Nuclear on one side, renewables on the other side, were put in competition for decades. Now, the governments have realized that they need to go full speed, both on nuclear and on renewables. That had triggered a lot of decisions politically. In France, to build 6 new reactors. In the UK, to go on after Hinkley Point with Sizewell C. In the US, to have 10 more reactors by Westinghouse in the next decades. And countries not involved in nuclear are now getting involved in nuclear. Countries in the Middle East, countries in Eastern Europe, for instance, of course, China continuing on their nuclear programs. So that's the first consequence. The second consequence, of course, is that we have realized that we will produce probably 40% more energy than today. And that the grids, the electricity grids, are absolutely not dimensioned to welcome and distribute that amount of energy. And so the amount of investments forecast on the upscaling of the electricity grids are incredible. So the investments will triple on the upscaling, I would say, of the electricity grids by 2030. So, for investors, that represents a huge opportunity. So I guess, nuclear and T&D will grow big time in the next decades.
It's so interesting to me, and actually it's a great segue to not a question I have for the panel, and I think, Laurent, you actually just answered it, but I think it's worth repeating.
And by the way, there is no contradiction, sorry to interrupt, there is no contradiction between investing in sustainability and being more profitable. Profitability of my company has gone from 11% EBITDA to 13% when the contributive turnover increased.
Yes.
So it's a mistake to think that sustainability would lead to less profit.
It's a very important point. Yeah. So my question to the panelists in general, and I'll just look for maybe 1, maybe 2 answers. We've talked about the scale of energetic demand. We've talked about some of the things that each of you are doing to answer that demand. And the question that I had coming into this that I was interested in your perspective on is, how do we achieve energy security while balancing those sustainability goals that we all believe in, or that we continue to strive for? So, how do we find that balance? Jean-Jacques, do you have a thought?
No, but I think in a way Laurent said it almost already. I think it's all about the mix of the production and the way you produce energy. So you can absolutely find alignment between the way you secure the energy production that is needed and sustainability goals. And if we look a little, for instance, at the long-term plans that are established in a number of countries, this is what they try to reconcile. So for me, the answer is in the mix.
Got it. It's perfect.
I think the answer is also about financing, but maybe we will touch on this issue before, because of, a lot of these investments are required by the public sector.
Yes. At
a time when, with the spending forecast in the US, for instance, in the Big Beautiful Bill, the debt per GDP ratio will reach 125% of GDP in 2030. In a country like France, we're already at 115% of debt per GDP. And some sectors in the energy sector, for the upscaling of the T&D networks, or for building new big nuclear reactors, of course, we will need a lot of public funding.
Yeah.
And so that raises a question on making the political choices in order to secure the financing of what is needed in terms of infrastructure for energy, because that will require, I would say, decades of work. And so if the visibility on the financing is not there, then you will have difficulties to convince all the stakeholders to get involved.
Thank you. So, Laurent, I'll just say you're doing an excellent job of segueing me here. You're doing a beautiful job. It's like almost like we practiced this, which we didn't actually. But I actually want to pivot the discussion a little bit where Laurent was taking us, which is the role of government and specifically the policy frameworks that have and hopefully will prove most effective in incentivizing clean energy investments. So, Laurent, maybe I'll come to you just for a view, perhaps closest to home in France, of what forms of government policy have you seen to date that have been most effective in stimulating investment in this space?
Well, I think the criteria are very clear. First of all, you need a multi-year planning. And that's where, in France, we have, many drawbacks in our political system, but we have also some assets. And some of the assets is to give some visibility on the targets in terms of decarbonization and what we're expecting from all the different sectors, so that the industries and the companies can plan their investments because they have some visibility on the targets by the government. So I think the multi-year program in terms of setting objectives and targets is important. The second is stability of regulations. Energy is a very highly regulated sector. There needs to be stability in this regulation, because otherwise that has an impact on the calculation of the private sector. And the third thing is that there will need to be a mix of public and private financing for the infrastructure of the future. And I think one great example is what the UK just has done with the Sizewell C investment, where 42% of the equity has been taken by the private sector, by private investors, CDPQ and others. Why? Because in the contract, there are some guarantees and security given to the private sector on the level of revenues, including during the construction period. And I think that shows that even in a sector like nuclear, where you thought this has to be funded 100% by the government, yes, you still have the ways, if you write the contract in a good way, to attract private money.
Perfect. Jean-Jacques, if I come to you, I'd be interested in Amundi or your view on how much risk governments should take on, maybe perhaps in the form of contracts for difference, when investing in clean technologies and sustainable infrastructure.
But I would answer by echoing what Laurent just said. For me, what is key in the government role here is really the long-term planning. This is really the thing that I believe has proved to be the most efficient. In the menu of options of what government can do, there was a French economist at the beginning of the last century who was named Pigou, who invented the concept of price signal. So as a French guy, he was considering that it needs to be delivered through taxes, because we love to create taxes in France. But the idea behind was by revealing the right price of things, and for instance of carbon, yep, by definition, you're giving the right incentive vis-à-vis all the economical players and actors. And this has proved to be relatively efficient in a number of geographies that have put an ETS in place. And I think we tend to forget that from time to time, that these price signals type of regulations works. The second thing, echoing again, Laurent, I think it's on the long-term planning. I think everybody's quite familiar with what has been the impact on IRA, the impact on the Green Deal. I would mention two other plans that are maybe a little less well known. Mm-hmm. First, it's the 14th plan in China in 2022 on renewable energy that has led to what the position of China is. And there is a high chance this year that China absolute emissions have decreased, whereas the power demand in China has increased. So a real first start of a decoupling of the emissions and the power demand of China because of the long-term planning. And the other one is the recent Japanese example of the 2040 plan that gives an ambition of 1 trillion investment into renewable. And I think this is exactly the type of long-term planning vision that is needed for investors and companies to position themselves going forward.
Thank you. Can I ask a follow-up question, Jean-Jacques, just for your thoughts on, interested in your perspective here, comparing maybe Europe for a second to North America, where Europe seems to have a little bit more consistency. We've talked about like consistency of policy, definition of pricing. Interested in a perspective as to why we're a bit more consistent in parts of the world and less consistent in others. Do you have a view?
For me, at the end of the day, we will judge where the consistency is in what are the capex of the corporates,
yes,
and where they put the capex going forward. And I think the type of decisions that are taken by, I would say, companies like Egis are 10 years, 15 years. I think in the last decade since the Paris Agreement, a number of capex have been reoriented, I would say, on both sides of the Atlantics and in other countries. And what I think we will judge on the consistency of the policies going forward if we see the capex projections evolve in one sense or another. So far, I think we see them still oriented as a shareholder of a number of energy companies in the right direction.
Okay, thank you. Mpho, I'd be interested in your perspective. We've talked a little bit about carbon pricing and assigning a price for carbon and how important that can be. I'd be interested in your perspective on the role of carbon pricing systems and cross-border mechanisms and the role they'll play in directing capital towards sustainable infrastructure and energy.
No, thanks again, Jason, for that. I think that's a very important part of what we need to do if we are going to be able to achieve the sort of nationally determined contributions that a number of countries, particularly in the emerging market, have contributed to, have committed to. If you look at a country like South Africa, right, a big part of our energy comes from carbon sources. We generate a lot of our energy from carbon sources. We are seeing the mix being diversified in terms of investment in renewables and other clean energy sources. But carbon still remains the biggest contributor to the energy that we generate. We have some of the big emitters that operate industrially in the economy. So this means that for us to be able to do what we need to do to meet our NDCs, we have to look at how we are able to take advantage of things like the Article 6 of the Paris Agreement to make sure that we are able to engage internationally and other neighboring countries and other parts of the world in dealing with these issues. South Africa has what we call a JETP, Just Energy Transition Plan, which its intention really is to say, how do we transition our energy from being very carbon intensive into being a lot more cleaner and sustainable in terms of how we go forward. We have been able to partner with a number of countries, particularly from the developed part of the world, in terms of putting finances and money into this to make sure that we are able to drive this forward. The question really becomes, how do you put projects on the table to make sure that you're doing this? But I really think it's about taking advantage of the different mechanisms that have been developed within the multilateral space and saying, how do we effectively use these instruments, these mechanisms that have been put together to make sure that we develop the carbon markets, those that are able to meet their NDCs much quicker are able to make their credits available to those that are not able to, and therefore together and in working together we are able to achieve the goals that we have said that we want to achieve. I'm convinced that there's a lot of money that's available for sustainable financing. Yeah. It's just a question of finding the right projects in the right places and being able to execute on those projects and working across borders to be able to achieve what you have set yourself to achieve. Thanks.
Laurent, did you want to add to that?
No, just to react on what Mpho just said. There is also no contradiction between decreasing the percentage of fossil fuel in the role in an economy and growth. If you take the example of Saudi Arabia, since they have entered into Vision 2030 and invested in renewables, in hydrogen, yes, in new sources of energy, the average growth rate of the country is higher than the average growth rate they had when they relied 90% on fossil fuels.
No, absolutely. And I think the point that you make speaks to what we have seen and experienced in SA, as I said earlier on. So for a period of time, we went through a very difficult, challenging energy space, where because of inefficiencies of our coal-based power stations, we had to endure some power cuts.
Yes.
That lasted for a period of time. But through not only improving the efficiencies of the coal stations, but also through investment in renewables, we have seen how much we can actually increase productivity in the economy by investing in renewables and having a proper mix of energy sources within the system.
I mean, it's a point that I'll touch on again as we move forward, but I think both of you have said it beautifully, that the energy transition does not need to come at the expense of growth. It does not. Eric, I'll come to you for your thoughts on, you've already articulated Jolt Capital's involvement in the space, not only from an innovative perspective, but also from an energy consumption perspective. I'd be interested in your perspective on key technologies or inputs that are required to scale a secure and sustainable economy, and are any of those inputs or technologies being overlooked by policymakers today?
I think before talking about technology, it's a question of industrial model that I would like to put forward, because our approach at Jolt is really about, is really first no nonsense, making things that work. And in this respect, we discuss regulation. We don't need major changes. I think it was mentioned. We need stability.
Yes.
I think companies, corporates, we see them on a daily basis. Companies are doing much more for sustainability than governments are doing on a daily basis, with a tangible impact in our lives, which is great. So, and my point is, we need to support these companies with smart and nimble industrial models. I am not sure we need gigafactories in many places, to be honest. We need more small, nimble, smart factories. We need to replicate them. We can position them everywhere. We can build plants around the world. We don't need to centralize them in one place or the other. And so I think this is, and what has been overlooked, to come to the second part of your question, in my view, let's phrase it like this: I have a dream, science, I think science, education, science is the new resilience. Brain is a new mainframe. We don't need, brain is a new mainframe, and unlike gigafactories, they don't go bankrupt.
Right. Laurent, just on this topic of the role of government and how they can incentivize continued investment and innovation in this space, Egis works on many large-scale infrastructure projects where you're in close collaboration with governments. Do you see major risks to ongoing funding in the near term from governments?
I don't see major risks in the short term. I see some challenges in terms of public finances, as I said, by 2030. And when you look at the geographies where the growth is expected to be the most, I would say, dynamic in the next 10 years, it's the US, I would say North America, of course, with Canada, and the Middle East. And so I'm trying to say, what are the common characteristics of these two zones? The first one is commitment on long term. All the countries of the Middle East have got a vision, which is a long-term vision. And in the US and Canada, long-term commitments have been taken on infrastructure. The IIJA, the IRA, the Big Beautiful Bill in the US. That has given confidence, I would say, to the stakeholders of the industry sector. And the vision and the commitment also on projects in the Middle East as well. Yes. And the second common characteristics of these two zones is, of course, the presence of capital. The main private equity, capital is in North America, but the biggest sovereign funds are in the Middle East. And so this is also a common characteristic. They've got the capital, they've got the vision, and that's why they're going to grow faster than the other parts of the world. Of course, the challenges for them is to attract the talents, but I think we'll talk about the talents later.
Yes. Okay, perfect. It's the perfect segue again. We've talked about energetic demand, the challenge of our time. We've talked about the role of government and how they can incentivize continued investment here. I would like to turn to the topic of the role that private capital can play in accelerating the energy transition. Laurent, I think you've already touched on this. So just a couple stats maybe for the audience. In 2025, in April of this year, there was a Mercer study that found that 70% of large asset managers, those with AUM of over $2 trillion, now integrate responsible investment goals into their strategies. According to a separate BNEF study from January of this year, global investment in energy transition reached $2.1 trillion in 2024, with private capital playing a significant role in this growth. And the IMF, the International Monetary Fund, estimates that further growth to $5 trillion annually is going to be required by 2030 to meet net zero goals, with $2 trillion of that being invested in emerging markets and developing economies. So my first question, Jean-Jacques, for you is, are there financial instruments that are either do not exist today or are not fully adopted that would increase investment in sustainable infrastructure? And if so, what are those?
Well, thanks. And for the record, out of the 5 trillion that are expected by IMF, we're roughly at 1.3. So we're a little short of almost 3.7 at the moment. I think before financial instruments, we need projects. That might seem a little silly, but I would say in Europe at the moment, I don't think there are any renewable profitable projects that are not financed. And so we just need more projects. And to have more projects, you have more corporates that are putting projects on the ground with more capex on that. And to have these corporates, you need to have shareholders that believe into that are backing them. And so I think a very important instrument that is an indirect one is the stewardship, the engagement that people like us, asset managers, are doing as shareholders vis-à-vis the companies, backing them in their sustainability agenda, because this is also what helps to have projects on the ground. Then afterwards, there might be needs for dedicated instruments. If you look at the green bond markets, this is almost a $500 billion market last year, with a huge increase, for instance, in the green bonds issued in China last year, 80%. So clearly this type of direct type of instruments prove to be efficient and are extremely used by our end investors. That's one. Second, you need, of course, notably in some geographies, and I think it has been alluded to, some blended finance type of instruments where there is a little capacity of de-risking taken by IFIs, MDBs, to de-risk a little bit the private sector, to take more risks, to be more exposed to some geographies. And that has proved to be efficient. Amundi, we created the largest green bond fund in the world in partnership with the World Bank 6 years ago that was based on that idea. And I think finally what you need, and you alluded to that, you need integration of these questions into the core portfolios.
Yeah.
As long as you integrate, for instance, net zero ambitions on behalf of our clients in our portfolios, naturally, you're going to allocate more capital to the transition and to sustainable projects.
Very good. Mpho, I'm curious, we talked about the scale, or I mentioned the scale of investment that is going to be required into emerging markets, developing economies. From the Development Bank of Southern Africa's perspective, how does the Green Bank, the DBSA's Green Bank and blended finance model reduce risk, and how does it help to attract private capital?
Yeah, I think it's as has been said, I mean, in order for us to achieve some of the objectives that we have to de-risk, right? There's a lot of concern around emerging market risk and sort of the tenure that you need to be invested for if you are going to fund infrastructure. Now, if I look at a country like South Africa, we have been doing triple Ps for forever and a day. So we have very successful triple P models. We have a renewable program that has been very successful, the bulk of it being done by private sector with a strong government backing in terms of guarantees. We are we are starting a new programs around transmission, which also will work around similar principles as what we did with the renewables. Now, what government has done in addition to that is to set up what they call a BFI. It's basically a blended finance mechanism where we accept that there needs to be a level of de-risking that happens to long-term investments. So you set up this BFI, you fund it, and you say for infrastructure projects that we want to do, we need private sector to come to play, but then we need to use instruments that as government we have to be able to de-risk this, and the BFI allows you to do blended finance effectively. Government puts in money into the project, and then it says the balance of this money to make this project viable, to make it deliverable, we then need private sector to come in, and we're seeing quite significant take-up of those offers. As far as green financing is concerned, it's exactly what I said earlier on. Money is available for funding green projects. It's a question of finding the right projects. The approach that we are taking is to emphasize more and more project development and project preparation, because our view is that the need is there, projects are there. The question is whether they are bankable and whether they are at a state where they can have, for example, pension funds coming in and investing pensioners' money in these projects. So we're starting to emphasize more and more around project preparation as a state-owned bank. How much money do we put into these projects to make sure that they are properly prepared and we are able to bank them when it comes to the time that we can take them to market.
Maybe a follow-up question to that, just to kind of delve a little bit into something you just mentioned, and you mentioned a couple of times. So you mentioned there's money there. We need more projects. We need more innovative projects. What's stopping that from happening? Is it technology? Is there anything that's stopping that from actually happening?
In our view, I suppose the big issue really has been around the preparedness of the projects that we see in the market. Whether these projects have gone through a robust enough process to get them to a point where private money can come into them and get them to be delivered. So this is why I'm saying that we are starting to, well, not starting, we've been doing this for a while, but to put a lot more emphasis on project preparation and putting actual money into project preparation. And I think if you look at it from a risk-reward point of view, I mean, putting money in early stages of any project, an infrastructure project, is quite risky. So you have to be, I mean, that's why we don't expect private sector to put a lot of money into this projects on the infrastructure side. And that's why you have systems like the blended finance instrument that we have and the project preparation facilities that we offer.
Laurent, did you want to add?
I mean, we are lacking engineers. You know, to be straightforward, we are lacking engineers right now. If I take the example of France, we graduate 45,000 engineers a year. The market needs at least 10,000 more. And this is the case everywhere. You know, Egis is working in more than 80 countries. In all the countries, there is a shortage of engineers. There is a shortage of carbon life cycle assessment people. There is a shortage of data scientists. So, you know, there is a huge challenge for the educational systems everywhere in the world to have, I would say, the young people taking on a lot more scientific and engineering studies if we want to meet our targets in terms of, you know, growing energy demand or sustainability.
Thank you. I'm gonna, yes.
And we need more engineers, and we need more identification of the nice projects, as we mentioned. I'd like to add this because you know, I mentioned at the beginning at Jolt, we have a data-driven approach in the way we source companies. We compiled one of the largest database in the world with 5 million companies. I can tell you, let's take the example of Europe and North America combined. Mm-hmm. For one company that has met a VC or a private equity investor, and that is entering this magic circus of fundraising, there are between 2 and 4, depending on sectors and geographies, which never met an investor. With CEOs, mainly engineers, usually having grown their business patiently, very sound companies, But you know, they are not in this magic circus. When you find them, first you build distinctive portfolios with great returns, but then you support new projects, new technologies, new companies for the decades to come. I think this is massive, and this is what we are trying to do differently.
That's great. Eric, if I can stay with you and maybe changing gears just a little bit, I'm interested in Jolt's perspective on how you choose to make investments in technologies within the landscape of geopolitical tensions, supply chain disruptions. How do you account for those wild cards in today's landscape?
You know, I think time is ticking. I see time is ticking, so I'll try to be crisp. Again, I think the first answer is back to facts and back to a data-driven approach. Point one, you want to rely on something tangible, which is intellectual property. This is true in many respects in energy spaces. Patents, okay? When you see patents, this is an advice to entrepreneurs. File patents, okay? Because then when you file a patent and it's a good one, you are a price setter. Clients come, they pay for your service because you are one of 2 or 3 in the world offering a service. We have the company that we recently sold, which is based in France and Singapore, controlling the quality of NVIDIA chipsets. 1 out of 2 or 3 in the world. Okay, massive. It saves a lot of resource when TSMC reduces the percentage of scrap building, engraving NVIDIA chips. And a lot of patents. They have a 50% plus gross margin. So another KPI, beyond patents, gross margin. It shows that you're a price setter. So this is, and then clients come from China or from the US. So this is also a solution to supply chain. So build distinctive technology solutions, and then you have something which is valuable. And then the last advice, obviously, is work hard, be aware of the trend, build a network of global partners to be here in Canada, tomorrow in the US, in Singapore, and monitor what's going on. This is what we are trying to build to our portfolio companies. And again, I think this is a hedge to many of the risks that we feel right now and which are for real.
Thank you. I am at time. So there was a topic of, I'm actually going to ask one last question because I think it's important. We touched on it, and I actually don't have it for anyone in particular, but I think it's important that we touch on this. We talked about one of the challenges of actually advancing here and continuing to make progress, and we talked about the need for minds, data scientists, engineers, others. So is there anything we need to do at the university level or with programs, scholarships, anything else that we should be doing to incentivize our youth gravitating towards this industry? Eric?
Very happy to start with this one because we timely launched an initiative recently, which is that we share, again, this magic tool that we have developed with a number of sovereign funds, with a number of universities, and with seed investors for free. So, by the way, happy to have a conversation with many of you guys because we are building a community. And you know, data is everywhere, so there is no value in data itself. We can share data. The key question, even for an investor, is what you do with data. It's not the propriety of data. But building this community is very helpful because I give you an example. When a seed investor tomorrow use our tool and finds a very nice company which is reaching 3, 6, 9 million revenues, and they can't finance it anymore, they will come to us as the next one in row because we have worked together with them for quite some time. Sovereign wealth funds, why do they like? In Europe, we have the EIC, European Innovation Council. They are using our data to build reports on the semiconductor industry. Is it worth building a cluster for new optical lenses in East Germany, or shall we do it in another part of Germany or in another country in Europe? Is it worth building a new cluster for, data science in Toronto, Montreal, or in that respect, in which specialization should we do it? This is a kind of question that we can answer, and the answer is definitely yes. So we are building this also with major universities in Europe, and we would, and I'm sure we are about to do it with many other this side of the ocean.
Thank you, Eric. So in conclusion, I'm just going to wrap up and pick up a few themes that I picked up from our esteemed guests here. One is the answer to our energy demand is actually going to come from diversification. It's going to come from innovation. And probably the most important thing that maybe we leave the group with is that innovation and energy transition does not need to come at the cost of growth and profitability. So I would like to finish by saying thank you to my esteemed guests, and thank you for joining me on the panel, and thank you for all your thoughts. Thank you to the group for listening and participating, and I hope you enjoy the rest of the Toronto Global Forum. Thank you.
Thank you.